Seems like those concerns about a global economic slowdown, and it comes on the heels of a record year for the energy sector. It was the only one in the green, up nearly 60%, but the rain may soon be over. My next guest says a combo of historically high prices and that looming recession concern could lead to meaningful demand compression. Let's bring in Kevin Book, Clearview Energy Partners Managing Director. Kevin, usually it's not the energy people who are bearish on energy. You know, everyone in their own sector is usually telling us why it's going to do so well. So I especially appreciate your contrarian point of view here. What are your concerns?
Well, Kelly, there's a couple of things going on at once. Glaringly, the recession risks are in front of us. Start a new year with pessimism, maybe, and get more optimistic as you go. There are some structural shortages still out there. And if you look at the world and you ask, what does it mean to put a price cap on Russian products? It probably sounds like there's more room for confusion, dislocation, and maybe price risk to the upside. On the other hand, demand looks a lot more responsive historically in recent years relative to price in the non-OECD as well as the OECD. My colleague Jacques Rousseau points out that when you have a lot of demand concentrated in one place, China, or in one product, in this case jet fuel, there's a lot of room for disappointment if they come up short. And so there are some reasons to have pause when you see weakness on the horizon.
Yeah, so as an energy investor, then we point out the oil field services, for instance, we've seen a sort of switch there where they've been outperforming lately. Why is that, and can that continue even with what you're describing?
Well, we look at the S&P subsector proxies sort of as a market intelligence look ahead at things to come. And to the extent that you see WTI underperforming the E&P subsector, underperforming the services subsector, you get a sense that maybe cyclical underinvestment that we saw during COVID is part of why you're not getting as much out of the shale patch in response to the call of high prices. And so maybe what we need here is more ability to get oil out. On the other hand, you want to be cautious about this, Kelly. Like everything else, if you're sliding down, all of energy tends to move with it.
Right, exactly. What are you concerned about in Washington in particular as we watch this fight for the speakership? And how could that impact energy investors?
Well, just to start with, if you were asking, are you going to get a lot of cooperation out of Congress? So far this week, you're probably not getting cooperation even within one party, let alone across two. Looking ahead, that means that the administration really has the spotlight for energy policy going forward. There's several things we expect. A lot of rules coming out of Washington. That's been in the offing for some time and really behind pace, but also federal superpowers, the ability to open federal lands to wind and solar, for example, but also to take a de minimis stance on offshore oil and gas drilling and to stave off onshore oil and gas lease sales. That likely to continue. Probably not a climate emergency declaration, Kelly, but we've seen a lot of really muscular intervention from governments over the last year. It doesn't look like it's about to stop anytime soon.
I find it odd that we have people telling us that the stock, like David Katz just said, the stock market already was defensive last year. Now he's getting interested in some technology, maybe some financials, because he's anticipating beyond the recession, let's call it. It's striking to me that financial markets are behaving in that way, while energy and commodities markets seem to be acting as if, we're still heading into this recession event. That timing difference, I don't know if it's going to mean that one side is right and one side is wrong, or if people who are bullish on stocks for the long run could also be bullish on oil, thinking, well, it might go down first, but then I can, in the back half of this year or into next year, it should recover. What would you think about that?
Well, I don't want to deliver a spontaneous PhD dissertation without the research time, but let me offer this. The oil market is tightly geared. A small change in balances can have a big impact on price. The forward expectations have a lot to do with the movement of molecules and electrons to their destination. You often can have room for optimism deeper into the future deck when you look past recessions into terminal values and discounted cash flows for equities. But when you're actually dealing with a surplus or a shortage in the energy market, it can rebound much closer to the front month and to the price you see on your screen in real time.